Hello again, your Cowboy Financial Advisor here at home. I wanted to talk about a second major portion of what your financial advisor does. Earlier, we talked about goals, setting goals, and how you can do them at home. You can sit down with someone you love and respect, an accountability partner or otherwise, and you can go over your goals with them. You can write them down if you want. You can say them into the world. But the majority of what is going on in the first 20 to 30 minutes of your appointment with a financial advisor is creating goals, setting goals, and creating the perceived need that you need to have a relationship with a financial advisor to accomplish those goals. Well, I'm here to say you don't have to pay for a financial planning fee. You do not have to pay for any services, expenses, management fees, overhead costs. You can do this for free yourself. And if I will show you, we can walk through it and we can go over it. The second portion of a major appointment with a financial advisor, if you've been investing with them, is answering the question, how am I doing? How am I doing? This is called, and I call this asset allocation. This is you should be asking, how is my performance relative to the benchmarks? There are benchmarks that are set. This is how the investments are compared. Bonds and stocks are different. And one of the biggest conversations a financial advisor is going to have with you is, well, we're not all in stocks and well, we're not all in bonds. So it's a blend of the two. And that's why I did a little shittier. And I mean shittier. Because if you have managed money and you are paying for an expense ratio, a management fee, which is often 1%, and those investments, which are stocks and bonds, and then you compare it to any benchmark, any blended benchmark, any proper benchmark, any benchmark. Because I worked on the accounts, please don't kill me, please don't shoot me. It's because there's anchors, it's because it's a bleed, they all underperform. And by all I mean 95 to 100% of them. There were portfolios that were massively underperforming. We tried not to sell those because, but still the best ones were still underperforming. So when you're comparing the best of all bad things, you see my body language saying, it was terrible, it's bad. You don't need it. You don't need that anchor. There's ways to get investments without that anchor. And when you free yourself of that anchor, we will make up for any bad investment decisions you can make by just buying very simple investments, very straightforward investments, Warren Buffett level investments. Warren Buffett, when he dies, he's not handing it over to professional money managers, which, by the way, 83%. This statistic, I will do a whole video on this statistic because Warren Buffett is handing his money over to be managed by the S&P 500. It's just a indexed ETF. Very low cost. It costs 8 or 9 1/100ths of 1% a year to own the 500 stocks in the S&P 500. Warren Buffett does not believe in managed money. Here's the statistic I was mentioning a little bit earlier. 83% of managed mutual funds underperform their benchmarks. And that's why I can say with such confidence and certainty that if you have managed money in bonds and stocks at a financial advisor's office and possibly are paying a financial planning fee, 1, 2, 3, possibly 4 fees, those are anchors that come off every year, bleeds. All that can be set aside, and that, because you're setting that aside, will make up for your asset allocation mistakes that your expert pro financial advisor might be offering you. What we'll do is we'll just talk about what Warren Buffett is doing, and he's just owning the S&P 500. He's not trusting any managed money. He's just saying, hey, when I die, I just put it in the S&P 500 and see what the United States stock market to do. And invest in the people of America, okay? That is lesson number 1, and it's also the application. If you were listening closely, it's the prescription as well. People are like, well then, so what should I invest in? Well, it's called the ETF index of the S&P 500. I actually have 5 low-cost ETFs that if you blend properly based on your age, income, risk tolerance, and these other things, these 5 ETFs, I'll just mention them now. The Aggregate World Bond Index, just a huge bond fund, just a conglomerate bond fund. U.S. government something bond fund. There's a few different ways to do that, but something of American debt, because it's very high. It's very high. American debt. Now, MSCI World EFA, just a blend of the world stocks. That's number 3. That's a good one because that can, over time, that's going to be your probably top performer. And then the S&P 500, boom. And then I think, and this one's up for debate, and this one's up for change, the Dow 30. So you got 3 giant stock funds, 1 international stock fund, 1 international bond fund, 1 U.S. bond fund, and then 3 stock funds, one of which is an international stock fund, and then 2 American giant ones, a 30 and a 500. Okay, so that was asset allocated. That's my whole asset allocation pitch just thrown out. That was the entire menu. That's what you do. And then what you do is you blend the ratio of those 5s. You could go 100% in one of them. You could go 20, 20, 20, 20, 20. Do it how you want. But no, you can't get in too much danger there either because you're owning ETFs. So I realize this is a long video, but this is also me with a short rant on the entire asset allocation model. The entire model of how I believe, and I'll say this statement with care, but how I believe if you invest under this model of these 5 ETFs and you cut your fees, because you've now cut almost all your anchors, every one of these investments you can own for 0.5% a year. I'm saying that with not guarantees, but I believe through ETFs and very, very low cost investing, 0.5% of expenses potentially is possible for all 5. Certainly the S&P 500 because it's like 9 basis points. So if we, anyway, average it, it's got to be under 0.5% a year. You cut all that fat out, even if you screw up with like, oh, these picks and I kind of messed them up, I submit, here's the statistic, you will get at least 80% of the performance of your financial advisor. And that's accounting for them just making mistakes that were right. Over time, because they have hundreds and hundreds of clients, there are situations where you just make mistakes that were right for your clients. So, and of course, the financial advisor is going to be a hero. Oh, we did it great. But they also know how to say it when it's a mistake against their client, and it's totally not their fault. And clients don't even know. Clients don't even know. You guys have no... You have no idea. It's like what probably goes on in a kitchen. It's similar to... So think of a food restaurant that you're at. It is what is going on in the kitchen. You don't want to know, but you really want to be part of the game, and you do want to get fed. And so financial advisors are going to take their 1% plus the other percent plus the expense ratio plus a financial planning fee. And all I'm here to say is that's okay, but we can do it for free, and I can show you how. So it's only $100 an hour to see me. Right now, it could go up. I hope I can earn your business enough to have it go up. But you can see me, and in 2 hours or less, I will teach you how to get 80% of the return from your investments of any financial advisor, and you can fire the financial advisor, no cost, no problem. Do it yourself because it can all be done online for free. Thank you for watching. Far longer than 5 minutes, but this is also, if you've watched this video, an asset allocation portfolio model that I have come up with that is just, I think it's simple and it's easy, and I think it just might do the trick to operate and save you a ton of money. Get the returns, get in the investments, you got to get in the game, you got to be in the stock market, but you can save a ton of money, you can cut a ton of overhead. Thank you for watching. It is a pleasure. Schedule an appointment. 2 hours or less. I think I can do it in 2 hours or less, and we'll be doing the paperwork that gets you out from under the expenses of a financial advisor and paying an expense ratio over 1%. You should never pay an expense ratio over 1% unless you're getting like free rounds of golf, because that's what we got. If you've got enough money to be getting all these free rounds of golf, then know that you're paying up the pyramid. But have fun golfing because you're paying for it. Thank you for watching.